Welcome to The Explainer. Today, we're tearing right into a fascinating corporate mystery. We're looking at Valvoline, ticker symbol VVV. Now, as you probably know, this is a 158-year-old automotive maintenance giant. They operate over 2,400 quick lube locations across the US and Canada, the famous 15-minute stay-in-your-car oil changes. But here's the thing. Right now on Wall Street, Valvoline has completely split the room. Sitting at a market cap of roughly $4.5 billion, the financial data coming out of this company is literally telling two completely different stories at the exact same time. It's a stock showing incredible, undeniable operational growth right alongside some truly terrifying financial warning signs. So let's dive into this and see exactly what the numbers are saying. The ultimate paradox of this stock is perfectly captured right here. On one hand, we have explosive operational growth. We're talking 25% EBITDA growth, and system-wide sales just crossed the $1 billion mark. Honestly, if you stop reading there, it looks like an absolute flawless execution machine. But then, you look at the other side. Concurrently, they have an Altman Z-score of 1.72. That officially places Valvoline in the financial distress zone. And just as a refresher, that's a metric specifically used to predict bankruptcy risk within the next 2 years. So how on earth can a company be growing sales this rapidly while simultaneously flashing major distress signals? Well, to figure that out, we need to unpack the undeniable green flags and then the terrifying red ones. Okay, Section 1, 7 green flags of growth. The bull case for Valvoline. Let's start with the positives and look at the sheer operational momentum this company is building. The absolute flagship green flag is this number right here, 25%. That is the massive year-over-year jump in Valvoline's adjusted EBITDA, essentially their core operational profit, bringing it to a highly impressive $162 million. And honestly, it's not just the sheer dollar amount that's impressive, it's the efficiency. Their margins actually expanded by 1/3% to 29.8%. In today's economy, growing your top line while simultaneously expanding profit margins at the store level, that is incredibly difficult to pull off. It really shows that customers are still prioritizing essential vehicle maintenance despite price hikes, and Valvoline is capitalizing on that perfectly. And the momentum doesn't stop there. Let's rapidly hit the other 6 green flags driving this bull case. First, Q3 earnings per share beat Wall Street estimates by 14%, coming in at 57 cents. Second, same-store sales grew an incredibly strong 8.0%. That shows real strength in both transaction volume and ticket size. Third, they aren't just squeezing existing stores. They actually added 47 new net locations, bringing their total footprint to 2,456, with a target of 2,900 by 2028. Fourth, guru-focused models estimate a GF value of roughly $50 to $52. That implies a massive 30 to 40% upside from current prices. Fifth, despite the heavy debt we're going to talk about in a second, they maintain a very high GF score of 89 out of 100. And finally, number 6, and this is a big one, insider confidence. The CFO recently purchased 10,000 shares of his own company for $318,000. Whenever management puts their own hard-earned money to work like that, it's a powerful, undeniable signal of internal confidence. Right. Let's pivot to Section 2, 7 red flags of ruin, the bear case against Valvoline. Because, as we shift to the bear case, the narrative changes drastically. Beneath all that flawless operational execution we just talked about lies a highly precarious financial foundation. We have to be objective and look at the 7 red flags that are keeping conservative investors far, far away from the stock. The first massive red flag, 43.6x. That is Valvoline's trailing price-to-earnings ratio. Guys, for a company in a mature automotive services industry, a 43x multiple is absolutely extreme. Now, to be fair, their forward PE does drop to around 16.5x, but that huge gap between trailing and forward PE tells us something crucial. It means earnings are expected to recover incredibly sharply. With this current valuation, you are making a massive bet on the future, not a present certainty. You're basically paying a premium price for future perfect execution. Then there's the second red flag, which is frankly pretty glaring. Despite all that amazing top-line revenue growth we just highlighted, their net income actually plunged by 63.5%, down to just $101.5 million. Earnings per share also dropped 63%. This leaves Valvoline with a razor-thin profit margin of just 5.17%. Think about that. For a business carrying the kind of massive leverage we're about to look at, a 5% margin provides almost zero cushion if the economy slows down or operational costs suddenly spike. And that brings us to the really terrifying part of the balance sheet, the remaining 5 red flags. Flag number 3 is that Altman Z-score of 1.72 we mentioned earlier. Again, that puts them firmly in the distress zone with an implied bankruptcy possibility in the next 2 years. Flag 4, a current ratio of just 0.70. This literally means their current liabilities exceed their current assets by 30%. For a service business with limited inventory, a liquidity crisis could easily be looming. Flag 5. A heavily leveraged debt-to-equity ratio of 4.75x. They have nearly 5 times more debt than equity, leaving them incredibly vulnerable to rising interest rates. Flag 6. Quantitative engines are listing 4 to 6 major warning signs, openly labeling it a possible value trap. And finally, Flag 7, a 10.47% short interest. Sophisticated investors, the smart money, have sold over 16 million shares short. They're betting heavily that this precarious financial structure is going to crack.
Moving on to Section 3, the Investment Framework Test, Facing the Legends.
So we essentially have an operational powerhouse built on top of a financial powder keg. How do the greatest investors in history view a paradox like this? Well, putting the data through their legendary frameworks results in a consensus rejection. First up, the moat analysis gives it a 5 out of 10. It definitely has brand strength and convenience, but it lacks wide regulatory or intellectual barriers. Next, the father of value investing, Benjamin Graham. Now, while sector relative engines might give it an 84 out of 100, Valvoline actually fails 5 of Graham's 7 absolute defensive rules. That PE of 43x and the current ratio of 0.70, absolute deal breakers for Graham. What about the growth at a reasonable price legend, Peter Lynch? It scores a dismal 36 out of 100. Why? Because the PEG ratio is well over 1.0, earnings are highly volatile, and the debt is just way too high. And finally, Warren Buffett. It scores just 46 out of 100 here. Buffett demands quality and safety. Valvoline's return on invested capital is just 8.66%, which is far below his 15% threshold, and the debt to EBITDA is too high. So all 3 frameworks unequivocally reject this stock based purely on its current financial structure. Let's wrap it up with Section 4, the final verdict. Growth at any price? All right, this brings us to our impartial summary. Valvoline is truly shaping up to be the ultimate test of the growth at any price philosophy. It literally forces you to make a stark choice. Do you trust the incredible store-level execution, or do you respect the dangerous balance sheet metrics? Based on the data from our sources, here is the breakdown by investor type. If you're a strict follower of Graham, Buffett, or Lynch, this is a hard pass. The absolute rules for value and safety simply fail here. If you're a growth or momentum investor, that 25% EBITDA growth and 8% same-store sales jump are undeniably attractive. It might be worth consideration, but you've got to acknowledge the huge risks. For the deep value contrarians out there, there is that implied 30 to 40% upside, so you should definitely add this to your watch list. But honestly, the most prudent action dictated by the data today is to just wait. Monitor the balance sheet closely. A single earnings miss could trigger a cascade of problems given that 0.70 current ratio. Wait for tangible evidence of debt reduction and balance sheet repair before you commit any significant capital. Which brings us to the ultimate question for you to answer today. When you look at Valvoline, are you buying into that massive top-line growth and insider confidence? Or are you looking at that Altman Z-score and the liquidity crisis and staying far, far away? Let us know in the comments below how you are weighing this crazy paradox. And hey, if you found this explainer helpful in breaking down the real metrics behind the headlines, please hit that like button, subscribe to the channel, and engage with us so we can keep bringing you these deep dives into the market's most fascinating companies. Thanks for learning with us, and we'll see you in the next explainer.